Today, we're diving into one of the most influential books in personal investing, A Random Walk Down Wall Street by Burton Malkiel. In this episode, we'll explore the ideas from Chapter 1, where Malkiel takes us through the early history of financial bubbles and what they reveal about human behavior in markets. Everything we discuss today comes directly from this chapter summarized, interpreted, and paired with modern insights to help us better understand how markets really work. Let's get started. Okay, so to kick things off, Burton Malkiel. He seems like the perfect guide for this journey, right? What makes his perspective so valuable here?
Yeah, absolutely. What's really striking about Malkiel is that he comes at this from, well, multiple angles, not just one. He actually brings three distinct viewpoints together.
Three.
First, he's got serious experience as a Wall Street professional. I mean, he started out as a market specialist at a major investment bank, and he was chairman of the investment committee for a big insurance company, even a director at a huge global investment firm. So he has this practical, indispensable perspective on how things really work day to day. It's not just theory for him.
That hands-on experience must be crucial. What's the second angle?
The second is his academic side. He's a highly respected economist, chaired investment committees, done specialized research on markets, investor behavior, all that stuff.
So he knows the research inside out.
Exactly. He's got that deep knowledge of, the academic findings and how to evaluate investment opportunities from that rigorous standpoint.
And the third?
Well, this one's maybe the most compelling. For many people, he's actually been a successful investor himself.
So he practices what he preaches.
He does. And he has a bit of fun with it, joking that academics aren't really supposed to make money, that knowledge is the goal. But the fact that he's done well personally definitely adds weight to his advice.
That combination is pretty powerful, isn't it? Wall Street insider, academic expert, and successful investor. It makes sense then that the book feels aimed at, well, regular people interested in their finances.
Totally. It's written for financial laymen, as he puts it, offering practical, tested advice. You don't need a background in finance, just, an interest in making your investments work better for you.
Okay. And one of the first things he does is draw a line in the sand, right, between investing and something else.
Yeah, a really crucial distinction, investing versus speculating. His definition of investing is pretty clear. It's buying assets to get reasonable, predictable income, dividends, interest, maybe rent, plus, hoping the asset itself grows in value over a relatively long time.
How long is long?
We're talking years or even decades. It's a long-term game.
Okay, so that's investing. How does speculating differ then?
Speculating is all about the short term, buying something because you think you can sell it for a profit very quickly, maybe in days or weeks.
Gotcha. So this deep dive, like the book itself, isn't really for day traders looking for hot tips.
Definitely not. He states up front it's not for speculators. It doesn't promise any get-rich-quick schemes. He even quips that maybe getting rich steadily would be a better subtitle. It really sets the expectation for a patient, considered approach.
Makes sense. Let's get to the core idea then, the random walk. What does that actually mean in the context of the stock market?
Okay, so the random walk concept is basically saying that future stock price movements, well, they can't be reliably predicted based on past prices or trends.
So knowing what happened yesterday doesn't really help you know what will happen tomorrow.
In essence, yes. Short-term fluctuations are, for all practical purposes, unpredictable. And this is where it gets quite controversial.
How so?
Because the implication is huge. It suggests that a lot of the tools people rely on, investment advisors, detailed earnings forecasts, complex chart patterns, might actually be, well, useless for predicting those short-term moves.
Useless. Wow.
Yeah. He uses that famous analogy, the blindfolded monkey throwing darts at the stock listings in a newspaper.
Yeah, I've heard that one.
The idea is that the monkey's random portfolio would likely perform just as well as one carefully picked by experts. It's a bit provocative, obviously, but it hammers home the point about the unpredictability of short-term market direction.
I can imagine that didn't go down well with the professionals. That's basically challenging their entire value proposition.
Oh, absolutely.
Yeah.
It kicked off a grand battle, as he calls it. Market professionals pushed back hard, defending their methods like fundamental analysis.
That's looking at the company's health, earnings, that sort of thing.
Right. And also technical analysis, which is all about studying past price charts and trading volumes to find patterns. They argue these can predict future prices. We'll get more into those later, as the book does.
And what about the academics? How did they react?
Well, the academics sort of doubled down and refined the theory into what's called the efficient market hypothesis. It comes in like three flavors: weak form, semi-strong and strong form, each suggesting different levels of information are already baked into stock prices?
Making it harder and harder to beat the market.
Pretty much. They also developed this new investment technology, things like beta to measure risk, and more recently, smart beta, though Malkiel seems a bit skeptical about that last one.
So, a real fight then.
A real tooth-and-nail fight, yeah. Because, there are big interests at stake. Academics are looking for tenure, recognition. Professionals are chasing bonuses, protecting their reputations. It's a fundamental clash.
Okay, shifting gears slightly, but staying practical. Let's talk inflation. Why is just holding cash such a bad idea over time?
Well, simply put, inflation eats away at the value of your money. If your cash isn't earning returns that are at least keeping pace with the rate of inflation, you're actually losing purchasing power year after year.
It's like a silent tax, almost.
Exactly. Investing becomes essential just to stay level, just to preserve the wealth you already have.
And those examples of inflation's impact over time are quite striking, aren't they? The newspaper price multiplying, 49 times?
Yeah, between 1962 and 2014, with average inflation around 4%, and the Hershey bar going up 20 times in price and shrinking.
Right, shrinkflation too. It really shows how even moderate inflation adds up dramatically over the long haul.
It really does. And while some analysts might be forecasting low inflation now, Malkiel warns against getting too comfortable. He points out that productivity growth isn't uniform across the economy.
What do you mean?
Well, think about service industries. It's hard to make a string quartet more productive, right? You still need 4 musicians or a surgeon performing an appendectomy.
True. Technology might help around the edges, but the core service takes time and skill.
Precisely. So if wages in those sectors rise, and they tend to cost, the cost will likely go up too. This creates persistent upward pressure on prices, meaning we probably shouldn't rule out faster inflation down the road.
So the takeaway is, even if inflation feels low, you absolutely need a strategy to make your money grow faster just to maintain your standard of living. Ignoring it is, well, a recipe for getting poorer slowly.
It really is. Which brings us back to the need for investing. But, and this is important, he stresses that investing does require some effort.
It's not just set it and forget it entirely.
Not quite. He mentions that story from Chekhov's play, The Cherry Orchard. The Ranevsky family loses everything not because of some catastrophe, but just through sheer neglect, not knowing how to manage their assets.
Okay. So even if you use an advisor or a fund, you still need to understand enough to choose wisely and monitor things.
Exactly. You need to know how to pick the right help for your situation.
But it's not all serious warnings and effort, is it? He also mentions that investing can actually be fun.
Yeah, he does. There's the intellectual challenge, matching wits with the market. There's the satisfaction of seeing your investments grow, maybe even outpacing your salary increases.
And learning about new stuff too, new technologies, new companies.
For sure. You end up learning about all sorts of innovations and trends just by paying attention to where your money is. He sees successful investors as often being quite well-rounded, curious, intelligent, and willing to put in the effort. It can be genuinely engaging.
Okay, let's dive into the actual methods professionals use. He talks about 2 main traditional theories for valuing assets, right? They sound almost like opposites.
That's right, the firm foundation theory and the castle in the air theory. And he says understanding both is really key to making smart decisions and, maybe more importantly, avoiding big mistakes. They represent 2 fundamentally different ways of thinking about value.
Let's start with the firm foundation one. What's the core idea there?
The basic idea is that every investment, a stock, a bond, whatever, has an underlying intrinsic value, like a solid foundation. And you can figure out this value through careful analysis of its prospects, its earnings, dividends, and so on.
So you do the math, find the true worth.
Pretty much. And the strategy follows from that. If the market price drops below that calculated intrinsic value, that's your signal to buy. If the price goes above it, you sell, because you expect the price to eventually come back down to reality, to that firm foundation.
Who came up with this? Or who really refined it?
Well, S. Eliot Guild gets some credit, but John B. Williams is seen as the one who really formalized it in his book, The Theory of Investment Value. He developed a practical formula based on future dividends.
Dividends, okay.
Yeah, and the key concept he used was discounting. It sounds complex, but the idea is simple. Money you expect to receive in the future is worth less than money you have today.
Because you could invest today's money and earn a return on it.
Exactly. So $1 promised next year might only be worth, say, 95 cents right now. You discount future earnings back to their present value. This idea, championed also by economist Irving Fisher, is now standard practice.
So the logic is solid. A stock's value depends on the cash flows, the dividends it's expected to generate over its lifetime, and how fast those grow.
That's the theory. But, and here's the big but, the crux of the problem, as Malkiel puts it.
Uh-oh.
It all hinges on making accurate predictions about the future growth rates, how long that growth will last. And that's incredibly tricky.
Right, predicting the future is hard.
Extremely. When markets get really optimistic, analysts sometimes joke about discounting the afterlife because the growth assumptions become so stretched. So that firm foundation might not be quite as firm or as easy to pinpoint as the theory suggests. It still involves a lot of guesswork about the future.
Yet this approach has been hugely influential. People like Benjamin Graham and David Todd, their book Security Analysis was like the Bible for generations of analysts.
Absolutely. And most famous, most successful practitioner is probably Warren Buffett, the sage of Omaha. His entire career is largely built on this firm foundation value investing philosophy.
Okay, so that's one side. What about the complete opposite, the castle in the air theory? Sounds much less grounded.
It is. This theory shifts the focus entirely away from intrinsic value and onto psychology. John Maynard Keynes, the famous economist who was also a very successful investor himself, really articulated this back in 1936.
Keynes, what was his take?
He argued that most professional investors aren't actually trying to figure out the true long-term value of a company. Instead, they're focused on figuring out what the crowd is going to do next.
Like predicting mob mentality?
Sort of. They try to anticipate how public perception and sentiment will build these castles in the air, periods of optimism where prices get bid up and the smart investor gets in before the crowd fully builds the castle, ready to sell when enthusiasm peaks.
And Keynes actually did this. I heard he traded from his bed for half an hour each morning.
Apparently so. And quite successfully made millions for himself and massively grew the endowment for King's College, Cambridge. So he definitely walked the talk on this approach.
So what's the underlying logic? If it's not about future dividends, what is it about?
Keynes explained it in his big book, The General Theory. He said, look, nobody really knows what future earnings will be. So investors spend their time trying to predict what changes will occur in the generally accepted basis of valuation. In other words, what story will the market believe next? What will catch the crowd's fancy? It's about psychology, not financial analysis.
That leads to his famous analogy, doesn't it? The beauty contest.
Exactly. The newspaper beauty contest. It illustrates the point perfectly.
How did that work again?
Okay, imagine a newspaper runs a contest with pictures of 100 faces. To win, you don't pick the face you think is prettiest. You have to pick the 6 faces that you think most other contestants will pick as the prettiest.
Ah, so you're guessing what everyone else will guess.
Precisely. And the really clever players take it a step further. They think about what other people are likely to think other people will choose. It becomes this game of anticipating mass psychology, layers deep. That's the castle in the air idea in an extreme form.
That sounds kind of cynical. Is this related to the greater fool theory?
It's very closely related, yes. The greater fool theory is just a harsher name for it. It basically says an investment is worth whatever you can convince someone else, the greater fool, to pay for it.
So fundamentals don't matter, only the expectation of selling higher.
In that view, yes. No price is too high, the thinking goes, as long as someone else is likely to be willing to pay a higher price. It's all about momentum and finding the next buyer.
And we still see echoes of this today, right?
Oh, definitely. Think about Robert Shiller's work on irrational exuberance, explaining bubbles like the dot-com boom through mass psychology. The whole field of behavioral finance has grown up around this, looking at how psychological biases affect our financial decisions. Daniel Kahneman won a Nobel Prize for work in that area.
Right.
And Oscar Morgenstern, another Nobel winner, was quite dismissive of finding intrinsic value, comparing it to fishing in the water or looking for fish on a tree, basically saying it's futile. He summed up this whole psychological view with the Latin phrase, res tantum vale quantum vendi potest.
Which makes
A thing is worth only what someone else is willing to pay for it. Simple as that. Value is purely subjective and determined by the market's mood.
Wow. So 2 completely different ways of looking at the world. One is all about calculated intrinsic value, the numbers. The other is all about psychology, the crowd, the story.
Exactly. And what's fascinating here is how these theories, developed so long ago, they still capture the fundamental tension in markets today. It really is a constant tug of war between that objective analysis or attempted objective analysis, and the power of collective psychology. That dynamic shapes so much of what we see.
So what does this all mean for you, the listener? If investing has all the elements of a dramatic climax, including the creation and loss of huge fortunes and these classic arguments about why it all happens, how will you use this understanding to navigate your own path down Wall Street?
We genuinely love to hear your thoughts on this. Jump into the comments section and let us know what resonated. Which type of wealth are you focusing on?
Yeah, let us know.
And hey, if you found this discussion useful, maybe learned something new, definitely hit that subscribe button. We do these deep dives regularly, exploring valuable ideas.
We appreciate you tuning in.
Yeah, thanks for joining us.